A massive week just gone draws February to a close, and as we enter the new month of March, there's still plenty to sink our teeth into from a financial perspective with a focus on jobs, interest rate decisions, and inflation. So let's get into it. Here are the big ticket items for the week according to Trading Economics, kicking off on Monday with the Caixin manufacturing PMI number coming out of China. Of course, there's continued speculation over the potential breakdown of trade between the US and China. 1 minute, there's talk of a trade deal between the two. Next minute, there's talk of further restrictions when it comes to chip sales into the country. And that volatility is likely to continue as people try to weigh up exactly whether China is a buy right now, quite frankly. Then we have the inflation rate coming out of the eurozone. It's coming off the back of some regional numbers, the back end of the week just gone. ISM manufacturing PMI coming out, the RBA meeting minutes from Australia, consumer confidence from Japan, GDP in Australia, the ISM services PMI on Wednesday from the US. Then we've got the rate decision from the ECB, trade data out of Canada, the IV PMI out of Canada, balance of trade, so imports, exports data out of China, unemployment rate, and essentially the jobs report from Canada, and wrapping things up with the US jobs report. So as ever, the first week of the month, you see that focus on the US jobs market. So let's kick off with the US. Now, there's been a big theme recently about the potential for economic weakness. Of course, when Donald Trump came into power, everyone immediately thought this is a person that is pro-growth, pro-markets. Every day that you saw a record high in his first reign in power, you saw him reminding us. He was telling us that the S&P was hitting record highs. Look at what a great job I'm doing. And so that really makes you think he's probably going to be hitting record highs on a daily basis throughout his tenure. But certainly the inception of his tenure also involves a lot of upheaval on this occasion. He's got both sides of Congress, and he's got a desire to move swiftly. Certainly the whole move under Doge means that there are question marks about the possibility for the jobs market to have some upheaval. Of course, in the past, any time that we saw significant job losses, we associated it with the possibility of economic weakness, that companies aren't hiring as much, or companies are getting rid of employees because they're essentially going in the wrong direction. There was always a line drawn against job losses and the downward direction of the economy. This time around, of course, we have the possibility of increased job losses over the coming months, but it comes down to the government. And so it's going to be really important to look at that breakdown in terms of government employees and private sector employees and job creation, because there's likely to be a significant disparity given the work that Elon Musk and co are doing. So what have we seen recently? We've seen the services PMI number falling into contraction back below that 50 threshold, a big decline in that. We saw weakness in terms of the jobless claims number, or higher number. We did see a flat, largely GDP number as expected. We saw stronger than expected durable goods data, but core durable goods less impressive, and that's probably more important. And we saw the Conference Board Consumer Confidence Survey, or consumer sentiment survey, not necessarily inspiring us. Let's move towards the downside across all three metrics. So where are we at the moment? We're in a position where the US dollar has been weakening as treasury yields weaken. Now, what might drive treasury yields higher? Well, higher inflation data for one, or inflation expectations. And what might drive it lower? Well, the potential for an increased number of rate cuts from the Federal Reserve and economic weakness. If we see that economic weakness coming into the fore, as we have recently, you're looking at the potential for further downside for yields, further downside for the US dollar. And so this time around, we've got the likes of the services PMI from ISM, the manufacturing services PMI, then the ADP, initial jobless claims. We've got the JOLTS job openings. We'll have the I can't see the JOLTS on here, but we should have it during the week. Then we've got the jobs report on Friday. So essentially, it's a week full of data coming at a time where we've been seeing poor data, and that's been driving down the US 10-year. And so, this is going to be a really big week for telling us whether that sort of underwhelming jobs data we've seen recently is something worth shouting about, or not, quite frankly. So strong data you would expect would help the 10-year and help the US dollar. Weak data pointed towards weak 10-year and weak US dollar. That's how it's been playing out recently. In terms of the sort of outlook for the jobs market, this is a sort of quick overview. I'll provide a deeper dive in a separate video. But essentially, we've seen a normalization of many of these metrics. Unemployment still remaining at 4%. So haven't seen a big surge in that. The downward trajectory for the non-farm payrolls has recently sort of popped upwards. So now it almost feels like we've probably plateaued between your sort of 100 and 300K. We're at 143 this time around. The expectation is that we're going to see something closer to 180. So an improved figure, but it comes off the back of a weak number for January, but December was a strong upward revision. So by and large, we're sort of there or thereabouts, just seeing some choppiness. So we're not necessarily, looking at something that out of all of this is super worrying. You would say arguably the average hourly earnings figure should be important because you're seeing it starting to tick up a little bit. So potential inflation concerns could rear their head. But I would just say, look at this from a sort of holistic perspective. If it's weak and it points towards a weak economy, you're looking at the potential for further downside in terms of yields and downside for the US dollar. So what have we seen over the course of the past week? We've seen a growth in expectations for additional rate cuts and a weakening for the hands of those thinking we're going to see a hawkish Fed that essentially sit on their hands for much of 2025. So calls for 0 rate cuts for the remainder of the year have pretty much disappeared. Calls for just 25 basis point cut, which a week ago was the base case scenario, that is no longer the case. That is now the third likely scenario. So we've seen a big shift over the course of the past week, and people are now thinking we see 50 basis points or 75 basis points from here, by and large. So you can use this tool. It's a free tool. It's from CME called FedWatch. Look it up. Check out the comparison tab. That will show you exactly what the current state of play is and the changes over time. Give you an indication of why some of these moves in the markets might have happened. In terms of a market to watch, I think one really interesting market is dollar yen. And that's because essentially, if you're looking at the possibility of economic weakness, but you're seeing downside in terms of equity markets, which is what we're seeing at the moment, then you see people thinking, well, if we're seeing a weak economy, but we're seeing a weak market, then you see the possibility of additional rate cuts from the Federal Reserve. That should be dollar negative. But weakness in terms of equity markets generally go hand in hand with haven demand and demand for the US dollar. So you start looking elsewhere. And so that's exactly what we've got here. So you've got the Japanese yen, which is another very common haven and one that is notable given the fact that we're seeing an uptick in terms of Japanese inflation, so the potential for further rate hikes. If we put the US 10-year yield onto this, you can see that this correlates perfectly. So it points towards the idea that if we see weak economic data, and if that drives the US 10-year yield lower, you're likely to see dollar yen continue its downside move. If we see strength in terms of the data and a more hawkish outlook for the Federal Reserve, you're likely to see upside in terms of the 10-year. You're likely to see upside in terms of dollar yen. So this is a really interesting one to watch. Of course, you can see just below where we are at the moment, or not far away anyway, you have this low down here. So it has been tagged, and now we're starting to see the bulls coming back into play. 148.63. Let's just quickly get this off. Right here, we've got the consolidation that's taking place above this 148.63. So essentially, you are in a position where we're at a key crossroads. If we start breaking up through your near-term resistance levels, the first port, of course, is going to be essentially 150. Above that is 150.73. That's when you start to call a bottom and you start to point towards a potential for a rebound for this pair. Until then, at the moment, we're sort of consolidating. If we break through these levels, we look for a potential wider rally coming into play. Possibly, even if it remains within that wider trend, you'd be able to come into this sort of wider trend here, that kind of area, right? So it'd be a retracement of the wider move. Much like what you're seeing here, right? You're probably looking at this on the intraday basis. We break up through resistance here. Doesn't necessarily mean we're going up here. We then retrace that wider move and come back to that sort of mean trajectory. We got carried away here there is a good chance that we rally back up into trendline resistance, but we need to break through these key swing highs in the near term, and we need to see stronger data for that to come into fruition. So these data points from the US are going to be really important for the week ahead. Next up, we can look at the eurozone, and you can see that essentially we're kicking off on Monday with the inflation data, and then we've got the ECB on Thursday. So plenty to go at here from the eurozone. Excuse me. Right, so first and foremost, we're kicking off the week with eurozone inflation. And while you can see here in terms of headline inflation, 2.5 expected, 2.7 expected, so flat across both of them, you might think it's not really that much going on in terms of eurozone inflation. Well, far from it, far from it. The expectation here is a 0.6 metric. That will be very interesting if that's what comes to fruition, because we are in a point of time where we're expecting to see significant disinflation. But if we start seeing strong inflation data coming out, then you're looking at the possibility that, you know, maybe that disinflation doesn't come to fruition to the same extent as might be previously expected. It's notable that generally January comes in weak, and we saw that last time around, minus 0.3. Coming off the back of the Christmas period, people are sort of fighting to get people to continue to spend, and then things sort of pick up a little bit in February, and that's what markets are expecting at the moment. In terms of the ECB, there's an expectation that we're going to see continued downside in terms of rates, another 25 basis point cut. Now, we're in a very interesting position when it comes to the eurozone. On one side of it, you've got the argument that the Russia-Ukraine war was the beginning of the downside move for the German economy and the region as a whole. And that when we see a deal, we could see easier access to Russian fuel, cheaper access to fuel, and we would see the economy picking up in a meaningful manner. The flip side of it is that Donald Trump's just warned of a 25% tariff. And so between the two, we don't necessarily know which of them is true. Now, there's talk of Canada and Mexico getting another stay of execution, and whilst they've postponed the tariffs for a month, they might do the same again. So maybe Donald Trump is showing his hand here with those Canadian and Mexican talks, in that he threatens a big move, 25% tariffs, which is what he's saying for the eurozone, and then it keeps getting pushed, and ultimately he has some sort of deal. And I think that's probably quite likely with the eurozone, quite frankly. The eurozone doesn't have huge tariffs on US goods, but it does for a few things that the US doesn't, most notably vehicles and agricultural goods. And so if you cast your mind back, there was a lot of talk about the US wanting to export agricultural goods, meat in particular, meat and cheeses, things like that, that people in the UK didn't necessarily want because of some of the hormones and drugs that are used for those products. So then, you know, are we going to see a sort of battle where the US is trying to push those products to get greater access to Europe? That is a distinct possibility. And certainly given the fact that Elon Musk is essentially at the helm here alongside Donald Trump, it's a good chance he'll push things when it comes to the automotive sector for greater inclusion. And quite frankly, you know, when it comes to the eurozone, what are they going to do? You know, I think there's going to be some sort of deal. There's got to be some sort of deal. And then, so when you're looking at the ECB, you know, what's their perspective? You know, inflation's very low. We can see 2.7 on the core number, the headline even lower. This core one, I think, is really interesting. Like I said, 0.6 expected on that month on month. You look back to the February from last year, that was 0.7. So if it comes in lower than that, then we're looking at disinflation. But you look at March, 1.1, April, 0.7. So over the course of these 3 months, there's a good chance that we get back down towards target from here. In particular, that March number, when that strips out, that's going to be a really interesting one. But you can see last time around, minus 0.95. The January prior, minus 0.9. So as you can see, generally we see January very weak. February, things start to pick up a bit. Will they pick up to the same extent as last year? Not sure. But if you look at that 6-month annualized metric, the figures over the course of the last 6 months put us on a trajectory of minus 0.9. That's probably not going to happen. But quite frankly, we are on a pathway back down to target, and the ECB are likely to be aware of that, and also aware of the fact that the economy really needs them right now. if you look at the sort of headline inflation numbers and you look at the annualized figures, let's look at the 6-month annualized like we were just looking at on the previous chart. So if the last 6 months are replicated again, where would these countries be on a year-on-year basis? The US are currently on a pathway to 3.6, the eurozone 0.3. So it's notable that the last half a year has seen significant, not disinflation, but essentially flat inflation when it comes to the eurozone. And so it provides the basis for the ECB to act. They already have been acting. And, where does that take us from here? There's 100% chance, according to Refinitiv, expectations that are market pricing based, 100% chance of a rate cut this time around. 96% chance of that is for a move to 2.5%. And then the time after that, April, you're looking at a 65% chance of another rate cut. From then onwards, you start to get a little bit iffy. Once we're at 2%, markets become a little bit indecisive about whether we're going to go any further from that. And so it really comes down to the outlook from the ECB. Given the proximity to what people might believe is a natural rate or a neutral rate, i.e. the rate where it keeps things, in check. You don't want to put them back down to zero. There's not necessarily a need for that, but you don't necessarily want them to be restrictive. So where will that be? That's going to be something worth watching out for on this time around. And certainly, I think, I did a short video about this, trying to cram a lot of information into 1 minute, where I'm talking about the German economy and the fact that if we're talking about tariffs at the moment, it's the Germans that are going to be hit hardest. Because they are the biggest exporter and they have a massive surplus when it comes to trade with the US. The flip side of it is that their proximity to Russia and their reliance on the industrial sector and manufacturing means that they stand to also benefit the most from a deal with Russia. So Germany is really where it's at the moment. It's been really outperforming quite heavily. If you look at, say, D40 divided by US 500. So if we're looking at it compared to the S&P 500, this upside move we've been seeing recently, you look, oh, lovely correlation. Well, that's not normally the case. So we've been seeing the DAX massively outperforming over the past 3 months against the S&P 500. What's the long-term trend? Quite the opposite. So you can see here that generally US markets outperform the German markets. That's not the case at the moment. We've seen this confluence between these two lines as German markets are now really leading the way. And a lot of that's going to come down to the outlook for the economy, which is reliant on things like what's happening in Russia, but also relations between the US and Germany and access to each other's markets. Do they impose 25% tariffs and keep it? Unlikely in my mind. But on the flip side, there is a good chance that he does try to take aim at the automotive sector, and that particularly can be felt by the DAX. So let's look at what the outlook is here for this market. So we can see over the sort of daily time frame that we've got that very clear uptrend. So the bias right now has to be bullish unless we see something to tell us otherwise. So what would that be? That would be a breakdown through your first swing low that would be down here. And particularly because of the fact that it would be coming off the back of a retracement here. It's a deep retracement, but we've rallied. We haven't broken through resistance. If we break down through 22113, then it looks like a potential wider pullback coming into play. Until that happens, we're sort of gradually regaining ground. So there is a good chance we see further upside coming into play here for the DAX. But like I said, this is a market that's likely to be highly volatile as we move forward, as we essentially try to gauge exactly what the state of play is in terms of how far will the ECB cut, how far will Trump go when it comes to tariffs, and how likely are we to find a resolution to the Russia-Ukraine crisis that gets us into a position that might benefit the German economy. A lot of question marks right now, but certainly it has been outperforming US markets and many markets over recent months. And that's why I think this is a really interesting index to be watching right now. And finally, let's look at the Canadian economy. I just realized that last chart was not in full screen, so apologies for that. So I've still got Australia written on the top, but it is Canada. I promise you that, as you can see on the left-hand side. So essentially, we've got the jobs report coming out on Friday. And the story here is one of potential weakness. Certainly the possibility of a breakdown in relations with their nearest and dearest trade partner doesn't necessarily put them in a particularly great standing. What's notable here is, of course, we've got this jobs report, but part of that is the unemployment rate. And we've been seeing the unemployment rate, which is the top one here, soaring, I guess you'd call it soaring, moving swiftly higher over the course of recent years at a greater pace than most of the other countries on this chart. So Canadian inflation on the rise, question marks around tariffs, significantly denting sentiment in the region. Then you look back at that annualized inflation metric. Where's Canada? Right at the bottom. So the past 6 months, we've seen significant disinflation in Canada and rising unemployment and question marks around tariffs. All of it points towards further rate cuts from the Bank of Canada. They're at 3% at the moment. So it's a 50-50 coin toss for a cut in March, essentially, near enough. Then, more likely to get that cut between March or April, but it doesn't pile on for another 25 basis point cut. So it does feel like things are slowing down a little bit. If you look at sort of the end of the year, where are we going to be? Maybe 50 basis points below where we are at the moment. This is likely to change depending on how those tariff talks go, how some of the data comes out. And particularly if we see that unemployment rate rise once again, it points towards a possibility of further weakness here for the Canadian dollar. But, we don't necessarily know that that's going to happen. Markets are currently pricing in a flat number, so 6.6 on the unemployment rate. The employment change figure expected to rise as well, heavily influenced by part-time work, interestingly enough. But average hourly wages you're seeing here expected to fall back to 3.5%. So let's look at the chart. So first and foremost, we want to bring up the chart against the pound. I think this is a really interesting one because it's a very clear-cut trend here, but we're rallying into a key resistance level. So this is a hurdle that either is overcome or not. Ultimately, we either reverse around this area and we continue to do what we've done over the course of the last, say, 5 months, or we break higher and then we push onwards and upwards. Certainly the trajectory over recent weeks has been impressive. And what's good about this pair is we do seem to have like pretty wide swings at a time with minimal retracements. So even on the downside moves, you're seeing that same kind of pattern, which is really nice for a trend following trader. So we're within that bullish phase, but we're at an area that in the past has marked a rejection point where we've turned around. Are we going to see something similar? Well, look out for a potential breakdown through this 1814 level for things to start to weaken and point towards a potential top. Towards the upside, you can see here 1.82 is the key level to be watching out for. So, we've got very clearly defined levels that we need to either break or not, to tell us exactly where we're going for this market. But certainly the pound against the Canadian dollar of late has been on a rip. And if we were to see, say, higher unemployment and something that signals the need for further rate cuts in Canada, given the question marks around tariffs, I think there's a good chance we do see a breakout and we exit this move, this consolidation phase that's been dominating for the past, say, 5 months. I hope that's been useful. Make sure to like, subscribe, follow for more. I'm now doing these daily short videos, so hopefully they're useful, trying to cover a wide breadth of topics that are notable on the day. But yeah, stay tuned for more content for myself, Joshua Mahony, Chief Market Analyst at Scope Markets. Have a great day, have a good weekend, and have a good week ahead.